Hey guys, this is Joe Boggs,
And Mark Starr.
and we are your elite team of Supreme Lending. We hope that everyone is taking time right now to invest in quality time with their family and staying healthy.
And we know this is one of the most uncertain times in all of our lives. So we wanted to help clarify one thing, which is the current mortgage environment. Some of you are industry veterans, and this information may be a little redundant, while others haven't quite yet digested what's going on in our world. So we want to provide a level of information to help everybody understand what's going on, and just right down the middle.
And I'll apologize for our lack of video experience. We are pretty good, we feel, at mortgages, but we're going to make some mistakes here. But to use Supreme Lending as an example, so we're a direct seller servicer of Fannie Mae, Freddie Mac, FHA, VA, and USDA loans. And what that means is that we write loans to their guidelines. Now, after that, once the loan's closed, we use our own money so that we can have full control of the scenario. Afterwards, we ship that off to, say, HUD, and they review it, and if they like it, then they'll insure the loan, and they'll remove that from our warehouse line. So we have two options. One is that we're going to sell the servicing rights after your loan is done and then approved to be insured by Fannie, Freddie, HUD, whoever. And then all we did was make money on originating the loan, and that was it. But we used our own money, so we have full control. Our second option would be to retain the servicing rights. So your client would be making a payment directly to Supreme Lending moving forward, and then we would make money on interest on a monthly basis.
So if you owned a bank, your mortgage concerns right now would be, one, people pull their cash out of the bank, decreasing the net worth, and the funds you're required to securitize you lend. It's kind of like Christmas classic, It's a Wonderful Life. And number two, the value of your mortgage portfolio has recently been cut in half because the value of mortgage-backed securities has decreased. Some customers refinanced, while others are in forbearance, so you're not getting paid. Your net worth has just been cut in half, so if your net worth was $2, you're now only worth $1. And number three, when investors get scared, they make a margin call. This is where they require the bank to show them the money. Typically, you must show them $1 reserve for every $1 you have in mortgage loan. However, due to the recent decrease in the value of mortgage-backed securities, these investors are now wanting to see $1.50 of the investment, so 1.5 times, and in the portfolio of reserves. So for your $1 in mortgages, you got to show 1.5 times that in reserves, which is a lot of money.
So to kind of give you a silly little analogy on what banks are going through right now is, so in your typical time, if we're going to have $1 in, say, mortgage-backed securities, assets, mortgage loans, we also have to have another $1 sitting over here on the side, right? To ensure something goes wrong, we've got the money. Well, what happens is you got $1 here and you got $1 there. Well, with a margin call, they've increased that reserve. So now we need $1.50 over here sitting in reserves just to ensure this dollar. It's like you going in the bank. This is fake money, by the way. It's like you going in the bank and the bank saying, hey, for every $1 you put in your checking, we need you to have $1 in your savings, like an overdraft protection account to cover it, right? So in reality, you would have $2 in the bank. Well, the problem is now it's a multitude of things. One is that the bank is saying, no, now you got to have 1.5 times that. So in your reserve account over here, your overdraft protection, let's call it, you got to have $1.50 for every $1 that you have in there. Now, here's the other bad news, is that mortgage-backed securities, due to the current environment, are of lesser value. They've dropped in value. So the bank comes back in and says, you know what? No, take it back. This $1 that you have in here in the checking account is no longer worth $1. It's worth about $0.50. So now you've got $1.50 sitting in your reserve account, but they're only going to give you only have access to 50 cents of your money. So that's one of the stresses that mortgage banks are going through right now, is when they're increasing the call that's due on the loan and the value of money is decreased as well.
Yeah, I mean, the harsh truth is simple as this. The money is drying up. So mortgage banks have 4 options. Number one, I'm out. And there's plenty of our competitor friends out there already doing this, just shutting things down permanently. The other, number two, for those that are trying to stay afloat, their take is, well, we'll just pause lending and see how things go. So they freeze operations, right? freeze their staff, freeze locks, all of that. There's even more that are exercising this option. Number 3, which is the reckless approach, is just to keep on doing what we've been doing, hope for the best, right? And truthfully, these are kind of the dummies in lending that will probably, do some loans that other lenders aren't going to do, and all of a sudden they'll be out of business as a result. And number 4 is continue to lend, but be conservative. Cut back on the programs they're offering, the riskier programs that have higher degrees of default, increase credit score requirements, and just shoot it straight down the middle of the fairway with what they're willing to do. Supreme Lending has $1.5 billion in warehouse lines and more than the required minimum reserves. So we're way good. Our 6-story corporate building is paid free and clear. It's a beautiful building. And we have really marginal overhead considering our volume. We closed over $1 billion in loans just last month alone. So we're extremely liquid and have chosen the 4th option.
All right. So we made it through that in one take, believe it or not. But where we are now, so Supreme Lending's chosen to take the 4th option. So we're going to continue to lend. Heck, we lent $1 billion last month alone, and we'll continue to do so. We're just going to be more conservative about it. So some of the things that have happened is that the programs and products that are more likely to either not perform or have forbearance, we're going to get away from that so that we can just stay solvent like we are right now. And so the first thing that's drying up are down payment assistance loans or loans where the borrower doesn't have any skin in the game. That's one of the first things to go. Second's going to be, well, actually, non-prime or non-QM loans, gone. Pretty much just gone, right? And down payment assistance programs would be next. Now, not VA, not 100% financing VA. That's a totally different animal. They perform better than any loan out there, and we're not affected on VA at all. So, great loan, good security for us, and so we'll do VA all day long. The other thing that we did was we realized that folks with lower credit scores have more opportunity for non-performance or for forbearance. And so that would be the last thing. We've increased our minimum credit scores now on your FHA, VA, and USDA to a minimum of 640. Pretty much every lender that's still around is doing that from all my competitor friends that I've spoke to. So that's not anything indifferent. And I will admit that we have right now $32 million in forbearance, which is about $190,000 a month that we're not receiving in income monthly, which is fine. We have high liquidity, so we're completely solid there. We're completely good, but we do want to minimize it, and that's why we're making some of these changes. Other thing I want to mention is the industry in a whole is kind of slow. Appraisers are taking longer, inspections, you name it, everything's kind of slowed down. However, we're still closing loans in an average of about 21 days because we prioritize our purchase loans, right? And so, in fact, we only work on refinances after 5 o'clock, and so that keeps our purchase loans closing on time. A little bit more stressful because things are taking longer, but that's about it as far as that goes.
Yeah. I mean, like Joe said, due to the current amount of loan volume and COVID-19, yes, everything is taking a little bit longer. Appraisal process, the underwriting, closing process. Everybody's working overtime around the clock. Weekends, our underwriters are rock stars. They're non-stopping it just to try and keep things, meeting closing dates for contracts. And we still have a really high success rate of that, even with the circumstances we're in. So, like Joe said, we're in good shape all the way around.
We still got money to lend out, and that's what we want to do. So we didn't want to be doom and gloom, but we know that you look at us for the experts to give you an idea of what goes on in the industry, and so we felt obligated to do that and bring that to you. So like I said, we're still rocking, we're still lending money. If there's things outside the box, it's going to become a lot more difficult. Even if you have someone who's pre-qualified now that maybe was using a bond loan, you really need to get a second set of eyes on that because it might be gone, period. There's no grandfather there. It could just be they're closing.
Plan B.
Yeah, they could be closing tomorrow, and the lenders say we don't do them anymore, and it's over. And so I would definitely get a second set of eyes to look at all the loans that you have in the pipe right now. As always, call one of us with any questions that you have. And again, we hope that you stay safe, and you stay healthy, and we look forward to seeing you again when all this is said and done. Thanks a lot.